Let's go straight to our second presenter, Imran Khan. Imran is a consultant at the IISS Geoeconomics and Strategy program. Imran.
Okay, so I'm going to talk about the GCC FDI inflows to India specifically. And though previous speakers have spoken at length and in some detail about the rising and growing influence of economic and rising and growing political and economic influence of Asia, just to set the context for this talk, I would just like to add that the rising China and India, both politically and economically, along with the major shifts of the energy supply side, which I guess Ambassador Ahmed won't agree, the US shale gas revolution have increasingly shifted the Gulf countries' economic focus towards the Asian continent. In fact, Asia has emerged as the largest trading partner of the GCC countries, accounting for roughly 57% of its external trade. The GCC's growing ties with Asia have been accompanied by intensified bilateral investment relations. Investors have discovered opportunities not just in the energy markets, but also in telecommunications, finance, real estate, transportation, among others. So this talk, I'm going to focus specifically on the prospects and trends of FDI inflows from the GCC countries to India, which are an indicator of the long-term investment interest of these countries. This paper aims to shed light on the pattern of GCC investment in India, defining the prospects in key sectors, as well as risk and barriers to future flows. In short, I will be discussing the trade between the GCC countries and India, the FDI flows from the GCC to India, challenges to attracting FDI from an Indian point of view, and the measures for encouraging FDI flows into India from the GCC. The nature of trade. India-GCC trade has grown phenomenally in the last 15 years. It has increased from 5.5 billion to 133.7 billion. That's an increase of 2,000% in the last 15 years. That being said, the nature of trade between the blocks or GCC and India is heavily skewed in favor of energy. Almost 40% of the total Indian energy imports come from the region, and 75% of which of the Indian imports constitute energy imports from the region. This heavy dominance is also reflected in India's trade deficit, which is with the GCC, which is to the tune of $35 billion. The deficit is likely to increase in the coming years with the growing domestic demand for energy in India and the volatility in oil prices. From an Indian standpoint, this imbalance is a cause of concern and needs some course correction through a more diversified trade basket. Just as like an analysis of this, so far India's economic outreach toward the region, so far at least, has been limited to oil diplomacy. Beyond oil and gas, India's partnership with the GCC countries has not really matured to the next level, both politically and economically. Even though with Saudi Arabia, we do have a strategic partnership. In fact, a coherent strategy for India's foreign policy towards the Middle East has not been articulated, unlike the Look East policy towards East Asia, which has seen the culmination of the Indian-ASEAN FTA. The trend of the GCC FDI inflows to India has got three notable characteristics. The second point, the aggregate FDI inflows to India from the GCC countries for the last 15 years total roughly only $3.5 billion. This is really modest compared to India's leading FDI partner like Singapore, Mauritius, and the US. Barring Oman and the UAE, investment from other GCC countries into India remain negligible compared to the global investment. For the period, for example, 2007 to 2012, the GCC FDI inflows to 130 billion globally, whereas India's share of this was only just 2.4 billion. So this is like really minuscule. This signifies that India has been unable to attract sufficient level of interest from the deep-pocketed sovereign wealth funds. However, this is despite the rising trade cooperation. However, India has encouragingly stepped up efforts to attract investment by further relaxing regulatory restrictions and inviting GCC investors to invest in Indian global robust story. For instance, in 2012, the Indian government invited the Abu Dhabi-based ADIA Investment Authority to invest in its infrastructure projects. Second, the trend of the GCC FDI inflows to India is reflective of the broad trend of that the UAE has been the most dominant investor in India, accounting for 86% of the total FDI inflows. Being the largest investor, FDI inflows from the UAE gives a fair estimate of the investment preferences of the GCC to India. For the period 2000-2013, the top 5 sectors accounted for 50% and 55% of total FDI from the GCC and as well as the UAE respectively. Coming to barriers, there are of course certain barriers or challenges that need to be overcome for increasing the share of GCC FDI inflows. The most striking is the legacy of investment dispute. Court cases involving several companies shook the confidence of the investors and has also influenced FDI inflows into India from the GCC. To this effect, Indian External Affairs Minister in 2014, while visiting UAE, has said, in fact, implored the Emirati investors to invest in India's Make in India investments program, and has provided assurances that not only their investment would be safeguarded, but would provide good returns. To this effect, another point is to highlight is in 2012, a high-level task force, HLTF, was established to address these legacy issues of institutional platform and investment flows. Some of the measures that could help overcome these barriers are a targeted approach would be required to channelize the sovereign wealth funds into India. An innovative approach has been adopted to invite the Japanese fund, as an example, for the Delhi-Mumbai Industrial Corridor. Both of the governments have contributed $4.5 billion each to the trust, and Japan has picked up a 26% equity stake in the corporation so formed. A similar arrangement would be perhaps required for with matching contributions on a G2G basis, which is government-to-government basis, to specifically invite inflows in the infrastructure project. Second, an aggressive political outreach would help bolster confidence and enhance investment flows to India in identified priority sectors. For example, in infrastructure sector alone, India requires $1 trillion investment in the next 5 years, of which nearly 60% would be private investment. This is an area of huge opportunity for the GCC countries because they have developed strengths in construction development, infrastructure building, ports, highways, airports, and also to this effect, FDI policy infrastructure allows 100% FDI on the automatic route, and recently the FDI policy in construction development sector has also been liberalized by removing the lock-in period of which was 3 years earlier. Similarly, GCC countries could also help establish the agro and pharmaceutical special economic zones, which would export processed food and pharmaceuticals to the GCC countries. This would be a win-win arrangement as Indian export basket would get diversified, and in GCC countries would be able to import products of which there is scarcity domestically. There are several other sectors of the Indian economy which present a unique investment opportunity for the GCC. They include energy, chemicals, electrical equipment, manufacturing, and textiles. Partnership in the services sector is another sector where it could be a mutual benefit between the two. Indian industry can help build a technology base in the GCC country, which would span the entire spectrum of telecom information, technology, software solutions, and so on. Similarly, in aviation, Indian and GCC can be a natural partners, given that GCC has emerged as a hub for air traffic flows from the east to Africa, as well as to the transatlantic region. Another point that I wanted to cover is that what are the outbound investment flows from India to GCC? Investment is always a two-way street. Indian companies have also established base in the Gulf region in the energy sector, fertilizers, steel, to name a few. Some of the GCC companies, especially in Oman and in UAE, have developed world-class SEZ, which present an opportunity for Indian investors to set up manufacturing bases over there in these countries. This would help Indian companies plug in the regional value chain, but also access other markets. Indian companies could also partner with GCC investors to target third country investments, especially Africa, where Indian companies have had a long-standing partnership. That would be a mutually beneficial partnership if an investment vehicle is created which analyzes Gulf sovereign wealth funds through Indian companies to Africa. In conclusion, India and Gulf countries have enjoyed long-standing relations, economic and socio-cultural, over the last couple of years, with India's economic growth and rising energy need, the GCC-India trade relations have intensified further. And also, presence of large Indian population has contributed to trade and cultural ties between the two. However, India has lagged other markets in attracting Gulf money owing to red tape and weak institutional infrastructure. Investment could receive a boost if India's economic environment becomes more investor-friendly, while also offering strong government support. Sectors such as infrastructure, energy, telecom, IT, automobile, pharmaceutical look promising owing to government's pro-business reforms and also due to the market size. Further, SEZs are expected to play an increasing important role in attracting FDI into India.
Thank you very much, Imran.